June 2026. A company goes public on the Nasdaq and, within days, briefly overtakes both Amazon and Microsoft in market capitalization. This company doesn't build cars. It launches rockets. This is SpaceX. And this isn't another "Musk is a genius" story. It's about a structure that used to be 3 separate companies, and quietly became 2, after SpaceX fully absorbed XAI in a deal Reuters called the largest corporate merger by valuation in history. Most retail investors haven't caught up to what that actually means yet. So let's not talk about vision. Let's talk about the numbers. Start with the most familiar name. In 2025, Tesla posted its first ever annual revenue decline in company history, down from $97.7 billion to $94.8 billion, roughly a 3% drop. Vehicle deliveries fell 8.6% for the full year, from 1.79 million to 1.64 million units. Q1 2026 looked slightly better on the surface, $22.4 billion in revenue, up 16% year-over-year, and Tesla reclaimed the global lead in pure electric vehicle sales from BYD. But deliveries only grew 6.3%, and inventory days on lots rose from 22 to 27, a sign cars are sitting longer before they sell. Meanwhile, Tesla's market capitalization sits at approximately $1.43 trillion as of mid-July 2026. Set that next to the actual car business, which generates roughly $40 billion a year. That gap is the story. Most of Tesla's valuation isn't paying for cars on the road today, it's a bet on Optimus, the humanoid robot, which has generated 0 commercial revenue so far. Musk has publicly floated a figure north of $10 trillion in long-term revenue potential for the robot business. But the current numbers tell a more modest story. A single Optimus V3 unit is projected to cost over $60,000 to manufacture in the second half of 2026, with production still under 10,000 units. No external customer has signed on. Tesla's own 2026 capital expenditure guidance jumped to over $25 billion, nearly triple what it spent in 2025, largely to fund this bet. There is one quieter bright spot: Tesla's energy division. Revenue there grew 27% with margins around 30%, and the company has $4.96 billion in deferred energy revenue still to be recognized this year. It's real, it's growing, and it gets almost none of the attention Optimus does. So Tesla today is effectively 2 businesses sharing one stock price, a car company under margin pressure, and a robotics story still unproven at the revenue line. For 24 years, SpaceX operated outside public markets. That changed in June 2026, when the company priced its IPO at $135 a share, raised approximately $75 billion, the largest IPO in history, and briefly touched a valuation near $1.8 trillion. Shares spiked as high as $225 in the following days, then pulled back sharply, settling in the $150 to $165 range by late June. What's driving that valuation? Starlink is now the backbone of the business. In 2025, it accounted for roughly 61% of total company revenue, $11.4 billion, up 50% from $7.6 billion the year before. By March 2026, active Starlink subscribers had crossed 10.3 million across 160 countries, more than double the 4.6 million subscribers at the end of 2024. Total company revenue for 2025 came in at $18.7 billion, with analyst forecasts projecting $36.8 billion for 2026, almost a doubling in a single year. But here's the catch: SpaceX still isn't profitable, so traditional earnings-based valuation doesn't apply. Measured purely against 2025 revenue, the stock trades at a price-to-sales ratio of roughly 141, compare that to Amazon, at around 5 to 6 times sales. Morningstar's own discounted cash flow model values the company at $780 billion, about 48% below where private markets had priced it, calling the IPO significantly overvalued. Here's the part of this story that hasn't fully sunk into public conversation yet. On February 2, 2026, SpaceX acquired XAI in an all-stock deal. XAI, valued at $250 billion, folded into a combined entity worth roughly $1.25 trillion. It's worth remembering that XAI itself had only become X's parent company through a March 2025 all-stock deal, so this was the second major merger in under a year. Why merge at all instead of XAI just staying independent and raising its own money? The economics explain it. SpaceX's IPO filing disclosed that the XAI segment generated $3.2 billion in revenue for fiscal 2025, against a $6.4 billion operating loss. In just the first quarter of 2026, that segment brought in $818 million in revenue against a $2.47 billion operating loss. Monthly cash burn is estimated at roughly $1 billion. Training and running Grok is extraordinarily expensive. The Colossus supercomputer alone has scaled past 1 million H100 equivalent GPUs. XAI needed a parent with actual cash flow. SpaceX, generating billions from Starlink subscriptions and launch contracts, was exactly that. On the product side, Grok has scaled fast. Monthly active users grew from 35 million in December 2025 to about 117 million by March 2026, largely through integration inside X. The current flagship model, Grok 4.5, launched July 8, 2026. XAI has also picked up government contracts, including a Department of Defense agreement and a federal procurement arrangement making Grok available across U.S. agencies. But there's an odd wrinkle worth mentioning. In May 2026, SpaceX leased part of its Colossus compute cluster, 220,000 NVIDIA GPUs, to Anthropic, a direct competitor to XAI, for roughly $5 billion a year through 2029. Reports suggest XAI's own training workloads were only using about 11% of that cluster's capacity, making outside leasing more efficient than idle hardware. It's a reminder that even inside this ecosystem, pieces sometimes make more sense working with rivals than with each other. So, does this all reinforce itself the way the narrative claims? The case for it: Starlink subscription revenue gives the combined SpaceX XA entity real cash flow that a standalone AI lab burning $1 billion a month simply wouldn't have on its own. Tesla's manufacturing experience could, in theory, help Optimus scale the way EV production eventually did. And XAI's models can now draw on genuine aerospace, satellite, and real-time platform data that competitors can't access as easily. The case against every valuation here is running far ahead of current financial performance. Tesla's stock, at $1.43 trillion, prices in an Optimus success story that hasn't started generating revenue. SpaceX XAI's combined $1.25 trillion valuation on a business segment losing over $6 billion a year, on top of a rocket and satellite business trading at 141 times sales, is one of the more aggressive valuations in modern market history. And structurally, Musk's voting control across these entities means public shareholders have limited influence over strategic decisions, something regulators in Europe, Asia, and the US are already scrutinizing, alongside separate probes into Grok-generated content. So where does that leave things? Somewhere between the hype and the skepticism. Musk is genuinely building an interconnected structure: Tesla, SpaceX, and now XAI under one roof, and that part isn't in dispute. But every piece of that structure still has to prove its economics on its own terms. Tesla's robots haven't shipped commercial revenue. SpaceX XAI is burning over $1 billion a month in its AI segment. And the stock has already swung more than 30% within 2 months of going public. This isn't a story about the next trillion-dollar empire being inevitable. It's a story about a high-risk, high-volatility bet, backed by real infrastructure, real revenue growth in places, and real losses in others. Whether it becomes history's biggest industrial empire, or history's most expensive lesson in overvaluation, is still an open question. The numbers, for now, only tell us it's genuinely both.